Welcome to Market Peeker. Candlestick patterns are powerful tools for traders, revealing market trends at a glance. Today, we'll cover the basics you need to know to get started. What are candlestick patterns? They're visual representations of price movements within a specific time frame. Each candlestick has a body, the opening and closing prices, and wicks, the highs and lows. Patterns form when candlesticks combine, showing potential market direction. Two main types of patterns to remember. Reversal patterns signal a potential change in trend. For example, hammer, a small body with a long lower wick, often indicating a bullish reversal after a downtrend. Shooting star, a small body with a long upper wick, signaling a bearish reversal after an uptrend. Continuation patterns suggest the trend will keep going. For instance, bullish engulfing, a larger green candle engulfs a smaller red candle, signaling a continued upward trend. Bearish Harami, a small red candle within the body of a larger green one, hinting at a continued downtrend. Pro tip: patterns work best when combined with other tools like support and resistance levels or indicators like RSI. Practice identifying them on demo accounts before applying them to live trading.